Effectively, the Federal Reserve is trapped. And the reason it's trapped is because the Consumer Price Index, which came out recently for the month of February, that is, well above the inflation rate that they are targeting of 2%. So the CPI came in at 2.46%. That's before the war. Clearly, there'll be an energy factor going into the next number, so that number should probably go up, going in the wrong direction for the Federal Reserve to cut rates. So they probably won't cut rates this time, and if we look at the dot plot going forwards, probably it will indicate less chance of having a rate cut in the future. The inflation measure that the Federal Reserve looks at is not actually the CPI, which is 2.46, but actually something called Core PC, that's Core Personal Consumer Expenditure Index. In November, that was 2.8%. In December, it was 3.0%. And in January, which is the latest figure, 3.1%. So that rate of inflation, which is the one they actually watch, is rising. So very hard to cut rates with a rising core CPE. Next release of core CPE will be for the month of February, and that will be announced on the 9th of April. So there's quite a lag between the time the core CPE comes out and when it's announced. So 3.1% and rising. As far as the economy is concerned in the United States, it's slowing. That's kind of reflected by the GDP number which came out. It showed that the fourth quarter had a large drop in GDP, which was over 4%. It's now down to 0.7%. So definitely a slowing of the economy there. As far as debt is concerned, it's hurtling towards $39 trillion. And the Office of the Committee for a Responsible Federal Budget, the CFRB, came out and said that we're in a debt spiral, and by 2031, the interest on the government debt will exceed economic growth. I'll just click over to that so we can have a quick look at what they had to say. So this is the Committee for a Responsible Budget. Let's just have a look at some of these headlines that they've got. I think we'll look at these ones here. The 12-month rolling deficit is 1.6 trillion in February 2026. They estimate, the Congressional Budget Office has estimated that the deficit was 1 trillion for the first 5 months of fiscal year 2026, which starts in September. So that would be, or starts in October, I guess. October, November, December, January, February. Yes, that's those 5 months. They spent 1 trillion more than they gained in taxes. I'm here to give you an update on the financial markets, the global markets, the economy, and the war. Now, just to preliminary, I'm not taking any sides here. And I'm also not giving any investment advice. So if you hear me say anything, don't take that as investment advice. Let's just start with what's going on with the war before we get on to the financial markets. So we're on day 18 of the war. No, it's day 19 now of the war. It started at the end of February, so we're 18th of March. That means that it's the 19th day of the war. The war has changed from a situation of surgical strikes to now a war of leader decapitation and assassination. The Straits of Hormuz effectively are closed, at least to Allied shipping, due to the Iranian threat, although Scott Bessent has said that they are allowing Iranian oil tankers heading to India and China to get through. So that's kind of odd when you've got the Iranians not allowing Allied shipping to go through, but the Allies allowing Iranian shipping to get through. But anyway, that's the situation according to Scott Bessent. We've had a blackout in Russia been widely reported. I don't know if it's true, but it's come from lots of reputable news sources. But basically it says there's been a kind of test of the great Russian firewall, which we've never heard about before. It's kind of a test for how they shut down communications in the event of any dissent or uprising. There have been some rumors of internal stability. The official reason for the internet blackout was due to drone attacks, and it's apparently also only limited to some cities like Moscow and St. Petersburg. We'll see if they're planning to shut down the internet North Korea style, where nobody can get any information. Of course, you may remember or you may know that if you're in China, you can't really get information very easily from the West. Today, or rather yesterday, the FOMC started its meeting, its regular monthly meeting about the interest rates. That meeting will conclude today, and we expect the rate announcement at 2 p.m. Eastern Time. I think that must be 8 p.m. Swiss time, if I'm not wrong, European time. The rate is currently 3.5% to 3.75%, the Fed funds rate. The market is pricing in virtually 100% probability that will stay the same. And here's the bit about the debt spiral. The Congressional Budget Office projects possible debt spiral as R exceeds G. R is the interest on the national debt, and G is the growth rate of the economy. And there's a few other projections here. The national debt will rise to 175% of GDP by 2056, and so on. Oh, there's something which is coming out. I haven't read it, but it's called the Fiscal Contingency Preparedness Act. Basically, it's an act that they're passing to deal with what happens if we do get this debt spiral, which is being predicted. What are they going to do? How are they going to deal with it? I don't have the answer. I don't think they have the answer either. What else is going on in the world? Oh yes, bonds are being dumped due to the deficit spending. So across the world, and this is all countries, the yield on bonds is higher than it was on the 1st of January, and also it's higher than it was at the start of the war. So yields have spiked up, which is counterintuitive, because normally in a war, yields are supposed to go down as people rush into the safety of government bonds. But it seems the world is looking more at things like the inflation risk, and that's why they're dumping bonds. Private credit markets, they're blowing up. We've seen quite a lot of private credit funds at the end of March announcing that they're going to gate redemptions. Gating means you've asked for your money back, you can't have it all back, you can only have some of it back. Now, private credit funds, what do? They lend money typically to middle-sized businesses, and usually they're quite bespoke loans, and typically these are the borrowers who can't borrow from a bank for one reason or another. So they may or may not take collateral. But the problem is these private credit funds are lending money to companies and individuals and other firms which can't immediately repay or don't want to immediately repay. They want to keep rolling their loans. So if too many investors come asking for their money back at once, they don't have the cash. And that's what's happened at the end of March. Now, the situation at the end of June, because these are quarterly redemptions typically, so the situation at the end of June will get a lot worse. So whilst we've seen quite a few redemption restrictions at the end of March, now everybody and his dog will be saying, do I want to be the last one in the queue for June? So those redemption requests will be being prepared now for the month of June. I think there's two things to think about. First of all, when a private credit fund gets requests for redemption, what do? They sell their best assets first, the most liquid assets. So they sell things which are easiest to sell first, and what's left, of course, can end up being the toxic waste, the stuff that the people who are still left in the fund don't want, i.e. illiquid, maybe worth less than face value if there's a risk to it. So everybody says, I don't want to be in a fund which might be left with toxic waste, so I want to be the first one out. So there will be this huge rush of redemptions at the end of the June, and the private credit funds know this is coming. So in order to minimise the impact, as loans mature, they won't be wanting to roll them over, which means many middle-sized businesses which have relied on the constant rolling over of these loans will realise that they're not going to get it, and they'll have to rein in their horns. They might have to reduce their stock, for example, or they might have to close down if they can't get the credit. Or worse, they might default on the credit itself. And that means the fund won't get the money back, which means a loss of value for the investors who remain in it. So that's bad for the economy when that's happening. We could this could go into a spiral. I think the private credit funds will often go to the banks and say, can you lend us some money too? And we'll have to see how reluctant or willing the banks are to lend money. But they obviously will have lent money in the past to some of these private credit funds. And that money must be now regarded as being at risk, at least more at risk than it was. So I kind of liken the situation to what they call Hotel California. You can check in any time you like, but you can never leave. And that's what a private credit fund is. You put your money in, you think you can get it out, but when you come to get it out, you can't get it. Sorry to laugh. I'm not laughing, really. I'm kind of sad that so many people didn't realize that this might happen. But realistically speaking, these waves of redemption are going to make it hard for you to get your money out in June. You'll probably get whatever is allowed, the 5% perhaps of your money, but there will be gating applied across most funds. What else have we got going on? So, as I said, bonds are being sold off and the yield is rising because they're starting to price in the inflation risk due to the war and the higher oil price. The 10-year yield before the war started was we're talking about USA. The 10-year US bond was 3.9%. Now it's 4.20%. 0.3% higher. And that's repeated all around the world. Let's have a quick look at the yields around the world if we can. I'll just go here and we'll go to have a look at the global yields. There we are. So the purple arrow shows you where the yields have gone since the 1st of January. And the war basically, if I take the US one here, the war basically started here at the end of February, where my cursor is, where the yield was 3.9%, something like that. Now we can see it 4.2% roughly. It might be moving around a little bit as we speak. But you can see all around the world, yields have spiked up just here at the end of February or early March, as soon as the war started. What else can we say is going on in the world? Yes, so let's talk about what's coming. If bonds are toxic waste due to, one, the war and inflation risk, and two, the deficit spending, which we're seeing is going to record levels this year. It's going to 39 trillion. I think it's 38.8 trillion at the moment. So bonds are toxic waste. Equities are challenged due to the slowing economy. GDP's gone down to a very low level. And of course, we're seeing rising unemployment. Inflation is rising, as we saw with the core CPE going 2.8, 3.1%. So where do people go? Well, I think if you are staying in equities, you want to stay in perhaps the safer side of equities. I mean, the companies I'd be looking at would be pharmaceuticals or healthcare, really. Consumer durables, that's things that you use every day, like toilet paper, soap, toothpaste, face cream, whatever. Anything you have to use and you consume or keep. I'd look at defence, see if there's any bargains there. And media, of course, media benefits from the fact that it doesn't have to transport anything, because all physical goods which are moving around the world are subject to higher energy costs, and many physical goods also contain plastics which are made from oil products. So media should be an interesting one to stay in. Now, it's not that I'm recommending any of these sectors. I'm not recommending them at all. I'm just saying if you want to be in equities, commodities, perhaps those are the better areas. I forgot to mention utilities as well. I think is not a bad area. I'm not particularly buying or selling anything at the moment, because I kind of sit on my hands. But for the short-term traders, you might want to look at where your assets are positioned. The other asset which I think will do well after we get through the initial selling phase, and we are in a selling phase at the moment for equities. I mean, if you look at the global equities, they're not coming off hugely yet, but we can see the early signs that they're starting to they have headed below the peaks and they're heading lower by the looks of things. Where do people go? They can't buy bonds, toxic waste, they can't buy equities, they're challenged. So they're likely to go into gold. Now, it's a bit early to say that the gold price will rise. It's sitting, as we speak, at about $5,000. Let's just have a quick look at that now. I'll bring up the precious metals. Where are we? There we are. So, in fact, gold has just dipped below $5,000. It's $4,995. Silver's dipping too. It's $78.81. The green arrows you see are the change in price since the 1st of January this year. So, what else can we say? The silver and gold miners some of them have produced their results already, and they were all very good, something like 3 times as much earnings per share, revenues significantly above where they were a year ago. So they're starting to bring out the results for the quarter ended 31st of December, and in many cases that will be for the full year ended 31st of December. But as I said, across the board, higher profits, significantly higher profits are being reported, and that was with an average gold price well below 5,000. In the March quarter, which is yet to come, we will have a gold price which looks like it could be hovering closer to 5,000 than I think 4,300 in the previous quarter. So that should give gold and silver shares a boost. Again, the silver price should be higher as well, as you can see on the chart. We've got the silver price. Where is it? Here, there it is. Since the 1st of January. Let me make everything since the 1st of January here, year to date. There you are. That's the silver price, slightly up year to date. But for the most part, it spent most of the first quarter above the... Let's move that down to there now. Yeah, it spent most of the quarter above the start of the year price, which is here at, what was it, about $72, something like that.